Hey, welcome to The Explainer. Today, we're going to talk about a real estate strategy that's, well, it's not about flipping houses for a quick buck. This is about building a steady, reliable stream of income, the kind that could actually lead to financial freedom. So take a look at this pyramid. It's a fantastic way to picture the whole journey, right? Most of us, let's be honest, start down at the bottom, kind of dealing with financial chaos. But the goal, the dream, is to climb all the way to the top, to that place of true financial freedom. And to get there, to really hit those top tiers of freedom and enlightenment, there's a huge shift you have to make. You've got to stop just working for your money and get your money to start working for you. And that right there, that's the core idea of financial freedom. It's that magic moment when the money your assets make is more than enough to cover all your living expenses. Suddenly, that 9 to 5, it becomes a choice, not something you have to do. Okay, so how do you do this with real estate? Well, when it comes to making your money work for you, investors pretty much take one of two main paths. Let's break them down. All right, let's get into the nitty-gritty. On one side, you've got the cash flow strategy. This is all about getting regular, predictable income, like right now. And on the other side, you have appreciation. This is more of a long game, a bet that the property's value is going to shoot up over time. Here's a really simple way to visualize the difference. Think of cash flow as having this little pot of gold that you get to collect from every single month. Appreciation, that's more like planting a tiny sapling and watching it grow into a massive, valuable tree over many years. So, if that idea of steady, predictable income is sounding pretty good to you, you're probably asking, how do I know if a property is actually a good cash flow investment? Well, there's a playbook for that. Let's jump in. One of the most important tools in that playbook is something called the cash-on-cash return. It sounds complicated, but it's super straightforward. It just tells you how much cash you're getting back each year based on the actual cash you put in to buy the place. People often call it the napkin test because it's a calculation so simple you could literally do it on the back of a napkin. Think of it as a quick financial health check to see if a property is even worth your time.
You know what? Let's just walk through a real-world example. You'll see just how easy this is.
All right, so imagine an investor is eyeing an apartment complex. The price tag? A cool $1.2 million. Now, they're not paying for all of that in cash, of course. They get a loan and put down $300,000. And that number, that's the one we care about. That's their total cash invested. Okay, so fast forward a year, after they've collected all the rent and paid for all the regular operating expenses, the building brings in $60,000 of income. But don't forget about that loan. Their mortgage payments, that's principal and interest, come out to $24,000 for the year. So to figure out what they actually walk away with, their cash flow before taxes, you just subtract the mortgage from the income. $60,000 minus $24,000, that leaves them with $36,000 in their pocket. And now for the big reveal. We take that 36 grand in cash flow and we divide it by the 300 grand they originally invested, and boom, that gives us a 12% cash-on-cash return. Now, it's super important to remember that this number is just a snapshot in time. It's a fantastic starting point for sure, but it doesn't tell you the whole story. I mean, it doesn't factor in taxes or that potential appreciation we talked about, or even the power of compounding over the long haul. So if that metric is just one piece of the puzzle, you've got to weigh it against the bigger picture. And that brings us right back to that fundamental choice, right? Cash flow or appreciation. So here's the real trade-off, laid out plain and simple. With cash flow, you get that predictable income, that stability. The downside? Wealth might build a bit more slowly. On the flip side, with appreciation, you've got the potential for some massive gains down the line. But you're taking on a lot more market risk, and you're not seeing any of that immediate income. And you know, in the kind of economy we're in right now, this is super relevant. Research from Goldman Sachs actually points out that income-focused real estate has, historically, given you higher yields than your typical stocks and bonds. And here's the kicker. It's a great hedge against inflation. Why? Because as costs go up, you can adjust the rent to match. Okay, so after looking at all of this, what's the verdict? Which path is the right one for you to build your future? Well, it turns out the answer might not be either or. A lot of the most successful investors, they actually find a way to do both. They use their cash flow properties to give them that steady income and pay down debt, while they hold other properties specifically for that long-term appreciation. But at the end of the day, the best strategy for you is the one that fits your personal journey. It all comes back to that pyramid we looked at in the beginning. It's about figuring out the approach that's going to help you climb it based on your own goals and how much risk you're comfortable with.
So, what's the big takeaway here? Understanding the difference between cash flow and appreciation isn't just some academic exercise. It is the key to making smart, strategic decisions for your financial future. So the real question for you is, are you going to build a reliable income engine for today, or are you going to plant a tree for a much wealthier tomorrow? The path you choose to build, well, it starts right now.